When trying to evaluate a company, a stock, right, there's many different metrics we can use. One of those is PE, because you see the share price of a company increase. But how do we know that it's driven by something other than just purely hype, right? PE is one of those indicators that we can use. To understand what PE actually is, in a simplified way, it's just the value of the share compared to how much money it is bringing in, specifically profit. So, in a very dumbed down way, if the PE was 1 and the share price was 1, that would be a PE of 1 because it's bringing in $1, the share price is $1, and the PE is $1. So, if the company is valued at 30, the PE is 30 and it's still bringing in $1 in profit. Now that's a simplified answer of it to illustrate a point, but essentially that's all PE is. PE is good for, like I said, determining if a stock growth is based off of money, more profit coming in, or more hype. There's good examples of both. Now, there are some companies that are not profitable and therefore do not have a PE ratio because they don't make profit. They bring in capital, they bring in revenue, but they're either pouring a lot more money into the business, or they have debt and they're taking on more debt, or they just aren't selling things for a profit yet. And that's not necessarily a terrible thing, right? But it does complicate stocks, and oftentimes companies that run up an extraordinary amount and then fall down an extraordinary amount are not profitable because people who are interested in the company aren't taking the check to see that, oh, it is indeed, overhyped because the PE is at this much, and it's a lot more complicated than that, but that is a factor going into it. It just makes valuations of companies significantly harder. Now, PE is complicated. You may ask, what's a normal PE ratio? What is a fairly valued stock? It depends on the industry and it depends on other situations as well. So I think the S&P 500 average is about 27. So that factors in the top 500 companies. The average PE ratio is 27. But there's going to be some companies with extraordinary growth. For example, like an AMD or an ASML. That has gone up a lot, and its PE ratio commands a lot. Or companies that are lower, generally banks. There's many big-sized banks in the S&P 500. Those ones, or financial institutions in general, those range usually under 20, just because they're never going to have the return as extreme as a tech stock, or very, very rarely they will, because of some of the things put on the industry. But that's diving a little bit too much into the weeds. So you just say, okay, I'll just find a company roughly around 27 PE, right? It's a bit more complicated than that. For example, AMD, 500%, you may say PE ratio of 200. Wow, that is 5 times, 10 times the PE we'd want, right? If it's 27, so we'd aim somewhere between 20 and 30. So this is 8, 9, 10 times more than we'd want. Well, that doesn't tell a full picture, right? Because forward PE is the forward outlook. How much are they going to be earning in the future? 50 is what it is. So it's a fourth of the normal PE, which is significant. That seems to throw things off a lot, right? A lot of AMD's situation of their PE being so high stems from merging or buying out a company and then writing off a lot of the debt as a loss in order for tax benefits, which is complicated, but it's a complicated way to say, hold up, PE isn't everything, or at least it's not the full picture. You can't just get a snapshot of PE and say, okay, this is the valuation. There's going to be many, many times where the PE doesn't line up, or it's misaligned with reality. For example, another example would be you get free money from the government, which sounds weird, but that happens. For example, Intel has gotten, with the CHIPS Act, injected cash into the business. So that counts as profit, even though you aren't really selling anything. Or maybe you're like Pfizer. We could pull that stock up real quick. Pfizer right now is unprofitable. They are not making a profit. However, their forward PE indicates 10.4. This is because, although they're unprofitable for the few quarters now, they are projected to be profitable relatively soon. And the amount of revenue they're doing, once it becomes profitable, it's actually really not insanely overvalued. Or it's not super high. But like I said, you could be, this is oftentimes when companies don't have a PE, they just aren't profitable in general. But sometimes they just aren't profitable for a short period of time, in Pfizer's case. So PE is a good metric. I factor PE into every stock that I buy. One of the first things I'm always looking at is chart price. How has this company performed? Is this a growing company? And what is the PE ratio? It does not tell the full picture. And past performance is never indicative of future results. However, it is a super important metric to factor into the bigger picture of the stock. I like to look for growth. I like to look for good leadership. I like to look for good industries. And I like to look for good value. Whenever you're buying a stock, you're usually going to have to compromise in one area or another. But that is for a different video. I'm really burpy today. I apologize. But we're at the end of the video anyway, so you can click off now. I appreciate it if any of you left a like, subscribed, anything like that. If you made it this far, if you learned something. I'm starting up this channel brand new. I've only been uploading for a week or two, so if you guys did enjoy the video and left a like, I would appreciate that a lot. But anyways, that's all I have for today, so I'll catch you guys next time. See ya.